Welcome. Today is Wednesday, January 18th. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and founder of Alpha Insights. And this is your daily six. Yes, we're going to try and sneak one extra chart in today. Before we get started, I did want to just spend 30 seconds reminding folks that we do publish an investment newsletter, and that newsletter is free to subscribe to. It's delivered directly to your email inbox around the first Saturday of each month. The next publication date is February 4th. The newsletter is affectionately titled Huge Insights, the Big Picture. And in that newsletter, we talk about key macro factors that are affecting the US economy and the markets. And for those who want more, there's also an option to upgrade to paid. We're on Substack now. So for as little as $10 a month, you can become a paid subscriber. And that actually includes our monthly market forecast, as well as our positioning recommendations. And paid subscribers also receive our Alpha Insights Idea Generator Lab publication, which details our top actionable trade idea. Every Wednesday, we send that out. It's actually an institutional publication, part of our larger Alpha Insights investment strategy service for institutions. So with that, I just wanted to get the show on the road here. We'll move to the first chart of the day. Before I jump into the details of the chart, let's just review what we talked about last time. We were on the show, I think, back on January 5th, and we went through what we called, the bear case explained. And through that, we kind of discussed, what we think fundamentally is affecting the markets. And, first point was that we're experiencing the most restrictive monetary policy experience in the last 40 years. And our fear is that the tightening regime that we're in right now could lead to a deflationary event. And we're already seeing that show up in the PPI today. The second thing we talked about is that the yield curve is currently deeply inverted, and that tends to be a harbinger for recession. And if in fact the predictive value of the yield curve remains consistent with history, then we will likely be in recession later this year. And historically, when we are in recession, the S&P 500 experiences a very large earnings drawdown, usually around 30% or so in an average recession. It's been worse, it's been less. Even if we got, say, half of that, we think that earnings could come in well below street expectations, probably in the mid $180 range versus the $230 that analysts are forecasting. And finally, we talked about the extreme valuations. We're in the 90th percentile. So, what we want to really do today is talk about some of the key technical factors that are leading us to really consider the idea that the market has much lower to go. And, we are, first and foremost, we're open-minded to the possibility of a cyclical bull market. We're just not seeing anything that suggests we're going to be there anytime soon. The chart we're looking at right now really tries to debunk the notion of a breadth thrust. There's a cohort of market watchers out there on FinTwit and everywhere else who, report to observe a so-called breadth thrust every time the market experiences something greater than an 80% volume day, 2 or 3 days in a row. And, the breadth thrust, for those who don't know what I'm talking about, it's an exceedingly rare event. It occurs only when the vast majority of common stocks rise aggressively and sustainably in utter synchronicity. Now, the chart on this page really looks at the New York Stock Exchange Moving Balance Indicator. That's the upper frame. And we're looking at it going back to 2018 or so. And the moving balance indicator was described by Humphrey Lloyd in his 1976 book, The Moving Balance System. And it's probably the most reliable measure of such a breadth thrust that we've ever seen tested. What it really does is it combines the ARMS index with two breadth measures, the 10-day moving average of the advanced decline line and the 10-day moving average of net advancing volume. And it expresses them as a percentage, 0 to 100%. And, the higher, the better, right? What we've noticed is that looking back at history, all the way since inception back in 1965 when I was born. We found that when the breadth measure exceeds 85% on a weekly closing basis, it usually represents a pretty credible breadth thrust. And that is a reliable buy signal for the subsequent 12-month period. The problem is the last time that the moving balance indicator posted a reading that was greater than 85% was back on June 5th of 2020. And before that, it was January 9th of 2019. And both of those were confirmed by big spikes to the upside. Over 90% of S&P 500 stocks were trading above their 50-day moving average at that time. If we look today, we're nowhere near 85% on the MBI. And if we look at the percent of stocks trading above their 50-day moving average, we actually got above 90% back in November or so, but we're putting in a lower high now. That's a negative divergence versus the strength in the breadth indicator. And so, from our perspective, this is a failed breadth thrust at this point. Unless we get the MBI above 85%, and we're not there yet, it doesn't look like we're going to get there anytime soon. We don't really have anything to talk about. Chart number 2. This entire rally that we've seen the last, couple of weeks, where we've had a very strong start to the year, right? The S&P was up 4% or so. Year to date, the top performers versus the S&P, have been some of last year's biggest losers. And so, if this year's biggest winners are just last year's biggest losers, why were they big losers last year? Well, let's take a look at some of these stocks. One of the leading stocks this year is Bed Bath & Beyond. It's a bankruptcy candidate. It's up 65% year to date. Carvana, also a bankruptcy candidate, up 55% year to date. AMC Entertainment, up almost 50% year to date. These are all bankruptcy candidates. The ARC Innovation Fund, which was down 77% last year, is up 18% year to date. And GameStop, another known meme stock, if you will, up 18%. I mean, these are junk stocks. This is a total junk rally. It's a short covering rally. And the problem with short covering rallies is that once the short seller covers, he's done buying. He's not going to go long. He made all his money on the way down, right? And so, that's why these types of sharp gravity-defying type rallies that we see in weak stocks, they're always short-lived and they always ultimately fail. If you think about it, when an institutional buyer decides to buy a position in a stock, they don't run it up 50% in 2 weeks, right? They take their time and they accumulate the shares steadily and methodically. And that's why strong stocks trend sustainably. So I wouldn't get too caught up in this rally. Chart number 3. We think another volatility spike may be brewing. If you take a look at the VIX versus the VVIX, the volatility of the VIX, which is the lower panel, what we're seeing here is that there's another divergence. So investor sentiment, the survey data that is, remains decidedly bearish, right? Everywhere you look, it's bearish sentiment. And if everyone's so bearish, then why did the VIX just post a new 12-month low last week? The answer is because everybody's not bearish. In fact, everyone's afraid of missing the rally, as evidenced by what we saw in the prior chart, right? And that's why the market's expectations for volatility over the next 30 days has declined precipitously over these last 2 weeks. And so, if we look at the VVIX, it's begun to diverge positively in recent days. And historically, those positive divergences have preceded sharp trend changes in the VIX. So, we're actually looking at this thinking that, we should expect a volatility spike of some significance in the days immediately ahead. So keep your eyes open. Chart number 4, defense versus offense. Changes in the trend of the ratio of the S&P Consumer Staples Index divided by the S&P Consumer Discretionary Index have long been considered to be a harbinger of structural change in the risk dynamics of the stock market. What we're looking at here is the ratio of staples to discretionary. So when it's going down, staples are underperforming. When it's going up, staples are outperforming. And this goes back to 2007, so around a 15-year look back. At present, This ratio appears to have put in a structural bottom in late 2021 and has since completed a bearish to bullish reversal to recover above a 14-year descending trend line. Now, the bullish inflection that we see above that kind of chart resistance level has been supported or confirmed by a positive divergence in the long-term momentum study below. You see that higher low in the momentum as the ratio made its all-time low in 2021. So, we've seen a breakout here above what was resistance, right? And now it's going to prove to be structural chart support. So the ratio's pulled back a little bit in recent days, weeks. We think it should hold above that structural support. And if it does, we should continue to see staples advance forward. And that would confirm this defensive shift in market structure. Chart number 5. Let's take a look at our Elliott wave analysis again. We're just going to look at primary degree models today. We've got 2 counts. These are 2 valid counts that we've been, we've had them under consideration, right? At the end of the day, we don't know which one's going to be right. The market will tell us. But our preferred Elliott wave count assumes that the January high marked the end of cycle wave 5, and by extension, the end of super cycle wave 3. And under that rubric, we count the June low as primary wave 1 down. We can count 5 waves at intermediate degree down to that June low. And that leaves us in of the opinion that that's the beginning of a major primary degree motive wave to the downside. And so, if that's the case, then the advance that rallied into the August high counts best as primary wave 2 up, all of cycle wave A down, and primary wave 3 down should be underway in the days ahead, right? We think that we've already seen minor wave 1 down, and that the advance that we've seen off that low is minor wave 2, and we'll talk about that more on the next slide. But the alternative view is what we're really focused on right now, because if the S&P 500 does exceed the December high at 4,100, that's the December 13th high, then it's possible that the market's tracing out a partially completed flat corrective waveform. Now, under that scenario, which we give a much lower probability, probably like a 30% probability, under that scenario, the current advance counts as wave C of a primary degree consolidation that will eventually be either wave 2 or wave B. We're giving this possibility that we've got a 3-wave decline, a corrective waveform ABC, rather than a motive wave, which is part of a larger corrective waveform. So, very complicated stuff. We don't have time to go into it. But the make or break on the preferred count is S&P 4101. If we take that level out, then we'll immediately shift to the alt count, which suggests that there's upside to as high as 4564. We're not there yet, folks, so don't get excited. Let's move to the next chart and just take a look at intermediate degree model of our Elliott wave forecast. This is a intraday 4-hour range chart. We begin this chart on the August 16th high, which we count as primary wave 2 up. And looking at that, we count 5 waves down at minor degree, which gets us intermediate wave 1 on the October 13th low. The advance off of that low is a very choppy, overlapping advance that looks to us to be a double zigzag, WXY, we've labeled it. And that advance peaked on December 13th. So we've also fallen from that level in 5 waves rather aggressively. That is definitely a impulsive decline. So part of a motive wave, we're counting that as minor wave 1 down. That bottomed on December 22nd. And the rally since then is something of a rising wedge, if you will. We're counting it as a triple zigzag right now. So far, it looks like it may have topped somewhere above the 618% retracement, but as of yesterday's close, we were only 40 points away from the 786 retracement. So we're open-minded to the idea that we can get up there as some final test. But it looks to me like we're going to break that trend line on the rising wedge, and that should be an initial indication that we've peaked. I think a break below S&P 3919, the lower end of the open chart gap, would confirm that minor wave 2 up is complete, and a decline into minor wave 3 down, and a culmination into a third wave decline at 3 degrees of trend should carry the market substantially lower down to our say mid 2000s target. Now, on the other hand, a sustained rally above that December 13th high would suggest that our alternate count is operative. So we're open-minded to that, but we need to see a breakout above 4101 in order to turn that on. At this point, we're comfortable with our view on the preferred count, and we expect the market to decline aggressively lower from here. So with that, I want to thank everybody for their time. And as always, good luck trading, and thanks for watching. If you do want to follow up with me, you can go to my website, www.jwh.com, and reach out to me from that point. Thanks very much.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.